You have your consumer, as you can see right there. You can see that I'm a phenomenal artist. Your consumer owns a home and they own an auto, okay? Here you have the insurance company, right? I'm with Farmers and not State Farm, to clarify, not State Farm. We are Farmers. Farmers, all right? However, State Farm is currently pushing back against a lawsuit that is requiring them to pay for claims that they did not cover in the policy, right? So the insurance company has a bank and they have all their money collected up in a bank, right? So when a customer wants to buy a policy, customer, let's just say they have this amount of money in their bank that they've earned and they want to cover their auto and their home. Let's say their home is worth $300K, okay? And their auto is worth $40K, right? They want to cover their $300,000 home and their $40,000 vehicle, right? If they get in a wreck and lose their vehicle, they don't have $40,000 in cash to pay for that vehicle to replace it, right? They may only have, let's say, 10 grand in the bank, okay? So they don't want to give up $40,000. If their house burns down, they don't want to give up $300,000. So what they want to do is they want to pay the insurance company to take on this risk, $340,000 in risk. So what they're doing essentially is they're paying the insurance company, say 30 cents a month to cover $340,000 in risk. The insurance company says, hey, I'll cover your $340,000 in risk if you give me 30 cents a month to cover that risk. They've got all this money just in case something happens. So it's like playing slot machines. The insurance company is banking that you're not going to have a mistake or something's not going to burn your house down, and you are paying them just in case something does. So it's like playing slot machines. Insurance company is playing slot machines hoping that nothing happens. So how does the insurance company determine that they want to charge you 30 cents, right? They consider all of these different factors to determine how much of a risk you are. Are you a big risk? And how much does the insurance company want to charge you to take on your risk, right? Well, they factor your house costs $300,000 to build. How much are materials right now? Are materials going up? Are materials going down? Are materials expensive or are they not? That's gonna, let's just say materials are going up, right? Wood is so expensive. So they say, you know what, since wood's going up, we're gonna need an extra penny, right? Automobiles are going up. So the insurance company says, you know what, automobiles are getting more expensive. We need an extra penny, all right? So as materials and things go up, they need more money to assume your risk. Have you had any accidents? If you've had accidents in the past 3 years, they might need an extra penny to assume your risk. What about your credit? Do you have good credit? If you have good credit, then that might mean that you're a pretty steady person. You pay your bills, you're on time. So you know what? They may say, hey, you know what? This person has good credit. We don't need that penny. They've got good credit. What about their driving record? Oh, they have a flawless driving record. All right, so we'll give them their penny back, okay? Here's another factor that a lot of people don't think about. Do you live in a high-risk area? If you live in a high-risk area, that might cause an insurance company to need a little bit more money. Do you live in an area near the coast where there is a lot of hurricanes? Well, guess what? That's more money because they're more risk, right? So the insurance company is betting all of their money to cover all of this risk, and they're only asking you for this amount per month. So if you wonder why your insurance rates go up or why your insurance rates go down, you can rest assured that it usually has to do with some of these different items here. If they're going up, it may be because there's different factors in the area that you're not considering, or maybe you have thought about it. Sometimes an insurance company will come into an area, okay? They'll come into an area and they'll say, hey, we want to beat all the other companies in this area and assume all this risk. We have all of this money right here and we can assume $100 million in risk. So what an insurance company will do is sometimes these smaller insurance companies, they have $100 million. They might come into an area, wherever you live, and they will assume $100 million in risk. Once they hit that, then they will start pulling out of the area and leaving. So how does an insurance company pull out of an area? Well, they pull out of an area by asking you to pay this amount of money for their policies. When a customer says, I don't want to pay this much, then they will leave this company and they will start going to another company. Therefore, this person or this company now has dropped their risk down to 50 million and they're more comfortable with that. So that's why insurance rates go up and down and they're always fluctuating. So the truth of the matter is, it's good to shop your insurance once in a while. And it's also good that you have an agent who can take care of you and shop your insurance for you. Hope that helps.